Good morning. Uh, Today we are going to discuss global markets correlations. Uh, in our previous classes, we have discussed how we'll analyze the market depending on the chart, and as we have discussed candlesticks, supply and demand, and patterns and indicators. So this is regarding to the chart that we have discussed. By seeing just the chart, what is the understanding that we are going to get? But today we are going to discuss a different topic, and it is a multiple markets and correlations. So, um, in supply and demand in a market does not depend just on the candlesticks and the price action. It also depends on the world economics, market conditions, uh, and global markets. As simple as it is. So, in order to understand what impacts a market in its supply and demand, we'll understand this topic today because, as you know, Iran and Israel conflict is going on, and what will be the impact of these kind of war situations in our market, we'll also discuss that thing. So in order to understand where how supply comes up into the market, how demand comes up into the market, what are the global circumstances, global scenarios that come into play when we are considering a market. So till now we have understood how a pattern, how charts are speaking to us, how the language of supply and demand is speaking to us through charts. This is what we have understood till now. But today we will understand what are the global economic conditions that impact these markets. So just not just because of the price action, not just because of the candlesticks, the market will move. The market also moves because of the world economics and overall global scenarios. So in order to understand global scenarios, first thing that we have to understand is we have to understand about the monetary policies of all the countries. So it is a brief introduction about global liquidity, and in order to understand this, first we have to understand this. As we have discussed in our previous classes, global economics play a major role on markets because in order for any economic activity, we need money, we need currency, and currency is being printed by governments. Governments are taking care of the how much currency is to be printed in a country, how much it needs to be circulated, and at what interest rates. So what does the government, how does the government create currency? For let's just say in its global reserve, it might be having gold in its global reserve. So depending on its global reserve and its market economy, a country prints its currency. For let's just say a country is printing over currency, what happens? Then automatically the country's currency value will depreciate because there are more amount of this also comes back to the same thing that we have discussed of demand and supply. When there is ample amount of supply, then there is a low amount of value towards it because let's just say for a goods we are paying 10 rupees, and when there is ample amount of currency in the market, what happens is some person will be ready to pay 100 rupees also for the same good. For a simple pen, a person is ready to pay 100 rupees, then that means that the currency value has depreciated significantly. So in order to maintain the currency value not impacting the world country economics, what RBI, Reserve Bank of India, and government, how does these control these currency value is they make interest rates. A 2 weeks before, what happened is RBI has reduced its interest rates by 50 basis points. So what happens when RBI reduces its interest rate is banks will be able to borrow money from Reserve Bank of India, and our Indian banks have borrowed almost 2.5 lakh crores from RBI just because it has reduced its interest rates. So what does this mean? So how this structure works is government prints its currency, government circulates currency, and if it overprints this currency, what happens is the value of the currency will depreciate. In order to maintain the value of the currency, what it does is depending on the global and Indian requirements, current RBI will not continuously depreciate its interest value. It will not keep printing the currency. It will control the currency. So in order to make value of the currency, so how does it do? For example, COVID happened. What happened in COVID? Economic activity has gone down, companies' profit has gone down, no job opportunity was there. So, in such a circumstances, what does the country do? It will create currency. It will create currency and it will decrease the interest rate. So, in order to move the economy, in order to grow the economic activity, it will induce its money into the economy. And what happens when a country when a government and RBI does it, a lot of people will be able to borrow that money and boost economic growth. And after boosting economic growth, if they keep doing that economy boosting economic growth, then inflation will come up. Inflation means the value of the currency will go down. So in order to control that, what they will do again, they will increase the interest rates. As they increase the interest rates, the money will again, which was in an economic activity, which was in a people's hand, it will again flow back to the government. After it's flowing back to the government, again the economic downturn will start, economic activity, economic growth will be diminished, and the companies will start not making much profit. So what happens is, after this cycle completes, again when the market is right for the government to induce economy, so this also is called quantitative easing, quantitative tightening. The things quantitative easing and tightening are the way a government and a reserve bank induces money into the banks, and through banks it will come into the people's accounts. So this is the activity that keeps going on. So monetary policies have a huge impact on the markets. So recently, before 2 weeks, Indian monetary policy, RBI has reduced 50 base points of interest rates for the banks to borrow more money. So what banks are doing right now? They have borrowed 2.5 lakh crores from RBI. So what does the bank do with the 2.5 lakh crores? They will give loans to the public. And what do public do? They'll borrow the loans and they'll boost economy. They'll set up new businesses, they'll purchase new vehicles, they will purchase new homes. So by doing these things, companies will get profited. And when companies get profited, automatically the profit will be shown in the charts, in their profit and loss accounts, and that is how economic activities run. So what we have understood here is, a country's global monetary policies have a huge impact, and a global monetary policies also have the same impact. So similarly, in US also there is a mechanism similar to this. When 2008 crash has happened, 2008 economic depression has happened, they also started quantitative easing. They always keep doing it, but they have increased it. And in COVID also, when Trump was president, when COVID happened, they have quantitative easing has happened, and later on they have increased the interest rates and quantitative tightening happened. And right now we are in a cycle where quantitative easing is going on. Right now, in November and September also, quantitative easing 25 base points have been decreased, and similarly in India also 50 base points of interest rates have been decreased. So by doing these things, what we are going to see in the next year or so is, we are going to see a lot of economic growth in our country on in global scale also. So this will boost the markets. So this is of critical importance of the towards the market, because what are markets? Markets are a representation of the companies which are making economic activity, and when a company gets profited, that is being divided into all the shareholders. So this is overall a share market is. So this is how global liquidity works. So when interest rates are cut, the money will flow into the people's hands, and people will do economic activity and economic growth that will impact companies, and companies will make profit, and that is being shown in the charts. So this is how a monetary policy of a country impacts economic growth and markets. So similar to this, global markets we are going to discuss. So correlations, global markets. So till now we have discussed monetary policies. Now we are going to discuss how global markets impact and what are the correlations mostly happen. So first we will come to the correlations. So as we have known, as I have told you, monetary policies have an impact on the market. So what normally happens is, when interest rates are high, we'll go to the chart. So in order to understand a markets, we need to have the 360 degrees of a market. So what is the 360 degrees of a market? Let's just say Indian market is there. Nifty is a 50, I mean 50% of what real market is. And after 50 percentage, the rest 50 percentage remains on the monetary policies, government policies, and uh, interest rates, most probably interest rates. So as we can see, here we can see that this is a Nifty chart which is going up as of today, and afterwards this is 10-year bonds, 10-year bonds and 10-year bond yield. So how these bond yields will impact a market is, when interest rates are high, what happens is money will flow into the government's pockets. How money will flow into the government pockets? Because interest rates are so high with the government itself, people will say that okay, giving my capital towards the other person is a little bit risky, so I'll park my capital with the government itself, where I'll be earning 5 to 10%, 5 to 10% of interest yield. So that is how these government bonds are made. So what is happening here? 10-year yield, 10-year bond yield. So when 10-year bond yield is increasing, that means that when market, let's just say in 2020, the 10-year bond yield was very low, but later on when interest rates have risen, so they push the bond yield towards the higher side. That means that when government is offering a good interest rate, people will park their money in the government bonds. So by doing this, government will again drive out the money out of the economy, and again quantitative tightening is done in this format. So what we are expecting right now is, because interest rates are coming down, so bond yield might possibly make a lower low. By bond yields making a lower low, what it means is that money which is in the government's hand, for the sake of interest government is providing, it will again flow into the economy, and when money flows into the economy, markets will pump. So this is what we are expecting. If you can understand, it is like a seesaw. When one is pressure down, another one is going up. So now what we are expecting is, because of the interest rate cuts, these bond yield curves are going to come down. When bond yield curves are going to come down, interest rates are going to come down, then people will start taking out money from these bonds and they'll be inducing into the markets. So when the capital liquidity is getting when they are bringing the liquidity in the bond market into the capital markets like Nifty, Bitcoin, S&P. So what happens is, there will be a boost in the S&P and Bitcoin and Nifty. So this is how the cycle works. So once economic activity is good enough, then again government will start, might be after 2 years or 3 years, it will again start increasing the interest rates. Then what happens? The monetary liquidity that is in the markets will again start flowing into the bond market, and by doing that, they will again decrease the Nifty. So this is a cycle. This is an infinite cycle between these two markets, between a interest rate, governments, RBI, bond market, and between the capital markets. So whenever there is a decrease in the interest rates, the capital will flow into the market. When there is an increase in the interest rates, then capital will again flow back into the government's pockets or bonds. So this will make the year bond yield interest go up. So this is how both the cycles are being managed, because if the government keeps printing the money, then inflation will go off. Inflation will be so high that we can't even afford a single loaf of bread. This happened in many economies like Zimbabwe, and even in Germany also, when there was a world war. So by excessively inducing money into the economy, it's also creates inflation. So in order to reduce the inflation, they will again increase the interest rates in the bond market, and the money will again flow to the governments. So this is how these two cycles happen, and right now we are at a point where there is a decrease in the interest rates, and that means there will be ample amount of capital flowing into the people's pockets, banks and capital markets. This will give a strong boost in the market. Then that is what we are expecting right away. For the next year and a half to two, we are expecting all the markets to go up because of the liquidity that is being induced into the capital markets. So this is a correlation between interest rates, bond yields, government monetary policies, markets, capital economies, and overall capital markets. So this is a correlation. This is a correlation between all these factors. So after that, how global markets. So how multiple markets are mostly global markets. One is US economy, which is the biggest, and another one is the Chinese, another one is Japanese, German. If you can follow four of these, and uh, cryptocurrency market, and also commodity market. These are the six main markets that we can follow in order to understand where the global markets are taking us, and where there will be an impact on our Indian market or crypto market. So if we can scan, if we can understand, if we can, uh, keep following these six markets, then we'll be able to understand what might be the impact on our Indian market. So let's just say today Nifty is growing. The reason I'll say today Nifty is growing is because Nifty was always in a very good space. Because of the interest rates cutting, there definitely will be a strong push towards the upside in Nifty. But it might not happen today, because the capital flow into the people's pockets and into the economy will take time. It is not a spontaneous thing that today interest rates have gone down, tomorrow money will be flowing into the economy. That will not happen, because people have to understand that there is interest rate cut in the market. So that means that we will be able to take loans on a lower interest rates. That means that there should be activity from the people side to take those loans, stimulate the economy, stimulate growth, and then the companies will be getting profitable. Let's just have a simple example. For example, you are taking a home loan. What happens when you take a home loan? When interest are down, you will be able to afford a home loan with a very small interest. So that means that you will be taking amount on your for your home loan, and then you will be purchasing some land, you will be purchasing steel, you will be purchasing cement, you will be purchasing Asian paints, or some kind of, in order to build your house, you will be purchasing some of the other things. So in order to do this, when you do this, automatically companies will get profited. They will get, sales. Cement, Ultra, Adani Cement, they'll get, sales. Steel, Tata Steel, Jindal Steel, they'll get sales. Asian Paints, Birla Opus, they'll get sales. So all this activity will be, all these companies will be getting profited out of this economic activity, and this will take at least a year or so. So what we are expecting right now is, yes, we have decreased the interest rates. RBI has decreased the interest rates, and the money will flow into the economy. It will take a year time, and then companies will get profited. Some person will not, might not be interested in a house, but they will be interested in a car. So when companies, when people are ready to take a loan, then they will purchase a car, and Tata Motors will go up, Mahindra will go up. So this is how economic activity is happening. And as we can say, the reason why Indian market, we are saying India market will grow. So we are talking about multiple markets. What happened yesterday? Yesterday there was a Iran and Israel war, kind of a conflict happened, and due to that conflict, what happened is crude oil prices have grown, because Iran is the largest crude oil producer. So when there was a war on Iran, so it means that crude oil stocks or crude oil production will take a hit. When crude oil production will take a hit, automatically what happens is crude oil prices will go up, because the supply will shrink because of the lower production on the Iranian side. So there will be a lower crude oil production, and when lower crude oil production happens, automatically the demand goes up. So this was expected by the market, and market crude oil prices have shot up by 10% almost in a single day. So what impact does this bring to our economy? Because crude oil prices have gone up, our own inflation will come up, because we need crude oil for our daily activities. Petrol, diesel, polythene, everything will be, costlier. Well, let's just say somebody has to transport a good from Delhi to Hyderabad. They used to make it at 10 rupees, but now since crude oil prices have gone up, they have to, increase this price from 10 to 12 rupees. So we got an increase of 2 rupees just because there was a Iran and Israel conflict. Because of the crude oil prices have gone up, we are facing the inflation in our own economy. So this is how markets are correlated. So not all countries are interlinked, all economies are interlinked, and commodities are also interlinked. So when there is a war in a country, then it has impact worldwide. So in order to maintain a good equilibrium, we have to maintain a understanding of how global markets are impacted and how that impact will be on our own market. So what we have discussed that there are six main economies that we can monitor: US economy, China. So I'll show you on my watch list. On a trading view, I have SPX, which is of the US economy. All these four indexes are of US economy. This is a dollar cost US currency index. Just like I was saying, the monetary policies have a huge impact on the currency market. So this is of a same US. Again, coming down, this HSI, this is a China index. As China is the second largest economy in the world, so it has a lot of impact when markets are going up. When Chinese economy goes up, then automatically it has impacts on Indian and Japanese markets also. And apart from that, I am following yield curves, 10-year bonds yield curves, and after that I am following other US economic conditions, because Bitcoin has a lot of impact because of Bitcoin. US economy has a lot of impact on cryptocurrencies also. So I trade mostly in cryptocurrencies. So when I have to monitor, when I have to understand what is going on in cryptocurrency space, because of that, I mostly have in my watch list US economical conditions. So depending on the US economical conditions, crypto markets move. Depending on the world circumstances, Indian markets move, because in a E-mini futures, this is a futures of the S&P index. So this has a positive impact today. This was increased by 1% today. So the reason why Indian markets are booming today is just because there was a strong future data that is coming up from the US, which shows that Iran and Israel impact is not there in the markets. Because Iran and Israel impacts are not there in the markets, there is an increase in the E-mini futures, S&P 500 E-mini futures. So because we have an increase in the market, we also see that our markets also going up. And similarly, even cryptocurrency markets, Bitcoin is up by 1% almost, and other small coins are also up by 1%, 2%. So what I'm trying to say here is, depending on the global circumstances, depending on the global markets, and depending on the monetary policies, there is a understanding that we have to have that our markets are also correlated with them. When there is a huge impact on the global economy, then it will also have an impact on our markets. When there is a strong push in this global economy, then we will also have a strong push on it. So there is a kind of correlation. Just like we have discussed price action, how it impacts candlesticks, how it impacts our markets. In order to understand the price action, we can say that 30 to 40% of our market depends on the candlestick patterns, price action, supply and demand. But 20% also we can relate to the economies, global economies, monetary policies, bond yields, and also global geopolitics also we can say. So geopolitics, they also play at least 20% role. So combined with this, we can understand that 60% of our market, when we are creating an understanding of how markets are going to perform in the future, then we have to consider this 60%. 40% is on the price action charting and indicators and everything, and 20% is on the how global economics are working up, how monetary policies are going up. So this is how we will understand how market reacts, why market reacts. When there is a huge news, let's just say somebody has dropped a huge bomb on Iran or Israel. So what happened when circumstances like this happen? When there was Ukraine and Russian war, there was an impact. India and US war, there was an impact. So whenever some kind of global catastrophe happens in the market, it has impacts on the market. And whenever monetary policies are being changed in the market, it also has a strong impact on the market. So this is how we'll see how global markets, correlations, economic conditions, monetary policies, these all things have impacts on our market. Depending on our trade that we are going to take, we have to consider all these things when we are going for a trade. When all the conditions are good, when there is no issue when there is no geopolitical issue, when the monetary policy interest rates are coming down, bond yields are also coming down, then they'll automatically money will flow into those markets. It will take time. um, Monetary policies or global impacts, they will take time for impact market. They are not spontaneous because interest rates are right away. This month itself we have cut 50 basis points. So in order for that money to flow into the economy, it will take at least 6 more months. So then after 6 months, or let's just say in 2026, we can see a strong bull run in our Indian market. So this is how markets are impacted. We have to understand this. We have to create experience of understanding global markets, correlations, monetary policies. Thank you. Short like this.